House prices forecast to plunge by the end of the year. Welcome to this week's edition of Money Matters. My name's Paul Smith, Touchstone Education, and as you know, I believe deeply that money matters. It's not about the money itself, it's about the choice to be able to live wherever you want in the world, doing whatever you want with whoever you want. We've made the choice as a family to move out here to Monaco. And a key part of us being able to do that is understanding why money matters and what's really going to happen to house prices. Let's go inside because they've got a number of articles that I want to talk you through. We'll put them on the screen, I'll let you read them, and I'll give you my view. Okay, so first up, let's just rewind that article, because what the article says, this is the first one I want to talk about, the Telegraph article. It talks about the fact that the property prices are forecast to plunge to 3.4% growth by the end of the year. What did she just say? She said that property prices are going to plunge to 3.4% growth. So in other words, your property is only going to be increasing, according to this article, by 3.4% a year. It's increasing by, as I record this, it's increasing by over 10. So if you'd have bought a property, let's say 2 years ago, you've probably had between 20 and 25% price growth. And if this year you only got another 3 or 4% price growth, well, that means that over the last 3 years, property prices have gone up by 25%. Now, for me, that's hardly a crash. And the thing that this article conveniently ignores is, number one, if you're a property investor, you get this stuff called rent as well. So your total return from the property is not just the value of the property. In fact, that's almost, you could argue, irrelevant unless you ever sell it, or I guess you remortgage it. So it's not totally irrelevant, but what's massively relevant is monthly cash flow. So my first tip to you is this: make sure whatever rent is coming in is stress tested at a high number. Now, why am I returning to this subject of house price crashes so quickly after I did a previous video on it? And if you haven't seen it, you should go and watch it. It's had more than 100,000 views, hundreds of comments, hundreds or thousands of likes. So please go and watch this other video over here. But what people have asked me, Paul, look, this is so important, could you give us a deeper insight? And in particular, could you look at what the media are saying and help interpret it in your language, in your brain? Because the way I look at the world is very different to the way most media, newspapers, etc. looks at the world. So number one, this Telegraph article that says prices are forecast, and forecast by whom precisely? Which expert has made this forecast? But even if they did drop to an annual growth of 3.4%, pretty good compared to, say, for example, 1.4% in the bank, isn't it? Okay, so let's take a look at this article from The Week. So it's theweek.co.uk, and the question is the UK heading for a housing crash? And there's a normal stuff in there about, the rate of increase is slowing down. Well, it's not actually, but we'll come back to that in a second. But what they're saying, I think, is a fascinating piece in the middle of this article, if you read it. And there is an actual expert that actually knows what he's talking about, that has actually correctly predicted the 2008-2009 crash, financial crash, not housing crash. And what he said is, yeah, there's probably going to be a downturn, but not until 2026. Well, that's 4 years away. And the article itself says, in the last 2 years, on average, you've probably gone up by 20%. So if, in 2026, property prices dropped by 5 or 10%, but between now and 2026, they go up by another 30 or 40%, is that a crash? I mean, if the average house is, round numbers, worth 300,000 now, and let's say by 2026 it's gone up by another 30%, which really would only be 10% a year for the next 3 years, wouldn't it? So that makes 30% on 300, which makes the average house worth roughly 400. And if that average house then dropped by 5 or 10%, it would go back down to 380 or 360 or something. But if you bought it today for 300, is that a crash or a boom? Keep coming back to this. Where else are you going to put your money so that it actually grows and you actually get a positive cash flow? And we'll talk about stocks and shares and we'll talk about other things as well, but I just want you to keep remembering that. But anyway, more of that in a second. Let's go on to article number 3. Okay, number 3. This is the Times, or more specifically, it's the Times Money Mentor, which is kind of a little online thing you can do to educate yourself in very, very basic terms about the nuts and bolts of finance. So you might want to check that out, the Times Money Mentor. This article is entitled, "When Will House Prices Fall?" Now, talk about a leading question. And it then goes quite reasonably through and starts talking about things. But even if you start by looking at the first sentence of the first line, underneath the headlines, it says, "Currently the market is overheated." Well, says who? I mean, they're just making this statement as if it's a fact. They then do, to be fair, go in and they look at why are house prices so high, the COVID effect, average house prices in the UK, talk about regional variations. They talk about people, as a result of COVID, wanting to move perhaps to the countryside, slightly bigger house, flat prices maybe go down a bit, house prices go up a bit, gardens, that sort of stuff. Is there a greater demand for rural locations? And that's all fine. But then they get on to, will house prices crash in 2022? And this article was initially released in December of 2021. And they talk about Hamptons are predicting house price forecast 3.5% each year between 2022 and 2024. Well, that doesn't sound like a crash to me. Lloyds Banking Group predicted that house price growth would be much flatter through 2022 at around 1%. Well, they got that wrong, didn't they? So that's Lloyds Banking Group, the bank, Lloyds. Completely and utterly wrong. As I record this, we are sat at 10%, not 1. Property consultancy Clutton's suggested that some parts of London could drop by as much as 10% next year, i.e. this year. Got that wrong. And Foxtons predicted a growth of 1 to 3% in the capital. Well, closer. So they're then talking about house price predictions for 2023 and beyond. And they're talking about potentially the Bank of England base rate will peak at 3%, and mortgages might therefore be 3.5%, 4%. But they do say that house prices are still historically low. So the headline is why house prices are high, and then they give all the reasons why house prices are so high. But the headline of when will house prices fall isn't supported by the article at all. But that's still the headline. And for 99% of the population, that's all they read. So if you're only reading the headlines, you're going to think probably that the financial world is about to implode and your house is going to be worth about 6 pence by this time next week. Completely and utterly wrong. Make sure you read the detail, make sure you do a lot of reading around the subject, and make sure you get views that are informed views from people that are actually property investors. Even if these doommongers are right, and even if there was some sort of 5%, 10% dip, correction, whatever you want to call it, crash if you want, what can we do about it? Because as I said outside on the balcony, I've been doing this for 40 years. So I don't want to come across as arrogant or anything, but I have seen all this before. So what's the best way to protect yourself? The best way to protect yourself is simple. It's education, it's network, and it's action. So for instance, if I take you back to the early 1990s, where mortgage rates in the UK were 14, 15, 16%, what did I do? Because I was connected to the right network. I actually went and get a BNP mortgage, Banque Nationale de Paris mortgage, denominated in francs, because this was before the euro, and I ended up paying 2 or 3% interest on that instead of 15% for local UK money. And because I knew the impact of massive interest rates in the UK and low interest rates in France will be to force the franc to devalue against the pound, not only did I save myself an absolute fortune in mortgage interest payments, but in addition to that, because of the disparity in exchange rates, the movement in exchange rates, I made nearly £80,000 profit when it came to paying that particular mortgage that I'm thinking about back. That's one mortgage. If you're connected to the right education network, if you've got the right group of people around you, and if you're prepared to take the right action, there's almost always a solution. I don't necessarily know what that solution will be, but if you're part of, for instance, Touchstone Education's community, and maybe you want to go on and do some of our advanced courses like boot camp or whatever it is, if you put yourself in a community of thousands of like-minded individuals, all of which are property investors, all of which are trying to solve the same problems, do you think, hand on heart, you're going to get a better solution than by reading the papers? I do. So what's your first step if you want to get that protection of education, network, knowledge, action? It's simple. If you've not been to one before, get yourself along to Wealth Through Property. 2 days, online training, great overview and introduction to all the various types of property investment. And that is your very first step. Now, from that 2 days, there'll be a link around this video somewhere. Click on that, get yourself some tickets to Well Through Property. It's online. From that first step, you can decide on the next step to take. Okay, number 5, I want to talk about the alternatives. So even if house prices do plunge to an increase of only 3.4%, what else could you do with your money? So if you're a property investor, I guess you could sell up and you'd have some cash. What would you do with it? Well, last time I looked, last week, and I said, what's the best savings account interest I can get in the UK at the moment? The best I could do for anything above about 5 grand is, because you'll see some headline rates of 5, 6, 7%, whatever, but that's only on the first few £1,000 of your savings. The best rate I could find for any significant amount of money was 1.4%. So keeping it in cash, no. Inflation at 10%, see my other videos, your money is getting destroyed. Please do not hold tons and tons of cash. Number 2, sticking it into some sort of savings account, 1.4%, no. Even if it is 1.4%, that's still less than half what you'd get if you keep it in property. And don't forget that property is also going to give you rent. Number 3, the stock market. Well, global stock markets have had their worst start since 1939. Many indexes are down 20%, 30%. Individual shares are down something, some shares are down anything up to 95%. Be very clear and be very sure you know what you're doing if you're going to stick all your money in the global stock markets. Cryptocurrency. Well, I'm a massive believer in cryptocurrency in the long term, but not next week. So if you're prepared to put your money into, Bitcoin and sit on it for the next 20 years, good idea. If you want to get any income from that Bitcoin for the next 20 years, it's not going to happen, is it? You can't generate income from holding or hodling Bitcoin, can you? So in simple terms, even if house prices do only go up by 3.4%, what else would you do with your money anyway? Where could you put it that it's safe? You might argue, well, gold. Yeah, okay, gold, good. But gold doesn't pay you any interest. You don't get any rent. So same thing. I'm a great believer in gold. I love gold. Put a couple of million into gold, be my guest. It will give you 0 income. But if you hold it for 20 years, probably massive capital appreciation. And for my money, genuinely, I think the UK housing market is safer than gold. And finally, what I want to do is touch on, well, what if you're not a property investor? What if you're a homeowner and you're watching this? The primary reason that you've bought your home isn't, I don't think, for capital appreciation, it's for somewhere to live. Now, if you sold your home, what are you going to do? Well, rent, I suppose. So you've sold your home, you've put your money in the bank, or whatever you've done with it, which won't be as good as keeping it in your home, probably. But now you've got to rent somewhere. Do you know what rental inflation is running at? There's many parts of the UK where the increase in the rent that you've got to pay is between 10 and 20% per annum. So if you put yourself out of the housing market and you're currently in it, you're going to be at the mercy of what rents can be commanded in your area, and they're going up very, very fast. Okay, back to the newspapers. Okay, so here we go with number 6, back to the newspapers. We are now with the Daily Express. Look at this. Look at this for a title. And this is actually quite interesting. Incredible reason why house prices won't crash this year. You didn't see that coming, did you? This is by a guy called Harvey Jones. And this actually, I think, is a piece of intelligent journalism. I'll let you read it, but what he's talking about is essentially, under most conditions, if interest rates start going up, then at some point, the amount of interest that people have to pay on their mortgages is going to slow the housing market down. And he's saying, actually, because we've got this recession coming, because we've got inflation, the Bank of England isn't going to be able to put up interest rates as high as they would like to, because they'll crash the entire economy. So they're going to have to keep interest rates low, and that means inflation is going to run away. And that's great if you are borrowing money. It's rubbish if you're lending money or if you're a saver. But the higher the rate of inflation, the quicker at which the value of your mortgage is getting destroyed, and the faster the value of your property increases. But his specific argument, which I do agree with, is that much so the Bank of England would like to put up interest rates to control inflation, as they did in the early 90s and in the 80s and so on. Because I've lived through multiple periods where you'd be paying double digits for a mortgage. His prediction, which I completely agree with, is that the Bank of England is not going to be able to put base rates anywhere near where they need to be to control that inflation. The best they're going to be able to do is 2.5%, 3%, possibly. Which means, as we speak today, you can still get a 5-year fixed mortgage for 2.5%, which is dirt cheap by historical standards. And his prediction, and my prediction, is that mortgage rates are still going to be sub 5%, even at the peak of wherever this recession takes us, which is incredibly affordable by historical standards, especially in troubled times like this. And as he said, you didn't see this coming, did you? And he's really talking not to you and me, but to all of his fellow experts in the industry. Okay, let's go on to the next one. Look at this article from the Financial Times. So we've got all the experts, well not all, but many of the experts saying crash, house prices are slowing down, this sort of thing. Look at this FT article. Now, I don't have a lot of respect for a lot of newspapers, but I'm okay with the Financial Times, especially when it comes to money. And what they're very logically saying is, well, we've got this group of people saying that house prices are slowing down. Well, what happened actually is that house prices rose faster in May than they did in April. So house prices are going up faster, and that's actual, real, current data. You've seen a decline in the overall year-on-year increase, lies, downlies and statistics, but the individual month, April versus May, prices went up faster. So you need to dig in that to understand it a little bit better, and I'm not proposing to give you a statistics lesson today. Let me know in the comments below if you'd like one. But the point is, the rate of increase as we speak is actually going up, not down, which is not a very helpful piece of evidence to all of the people that want to argue that prices are going to slow and then crash. So have a read of this FT article and make it your business to inform yourself. Don't just read the headline and think, oh yeah, house prices, because you're never going to get to an informed, educated decision if you're just reading the headlines. But that, of course, is what the red tops want you to do. Let's just pause for a second as we go on to point number 8 here. Even if the doom-mongers are correct, and I've shown you an article that says, 2026 prices might drop by 10%, and yeah, they might. But let's take a more general argument. Let's go all the way back to the crash, the 2008-2009 financial crash, where, yeah, some property prices, especially in London, dropped. My portfolio, which was essentially in Yorkshire and Scotland at the time, maybe 5% down. But if that stopped you from investing in property from 2010 onwards, you've missed the opportunity to double your house price. But then let's roll forward to Brexit. And you had that 5 years from 2015 to 2020 where, oh no, Brexit's going to destroy housing. It didn't. And then we had 2 years of COVID. And now we've got the war in the Ukraine. If you want to, you are very capable, I'm certain, of finding a load of reasons why you shouldn't do it and why it's going to be disastrous. That's why I'd encourage you to get out of the global negativity that 99% of people live in. Real world society. Sounds too good to be true, probably is. No such thing as a free lunch. Who do you think you are? It's going to end in tears. And if you would like to get a positive supporting community that gives you reality as opposed to negativity and will boost your confidence with inspiration, then join the Touchstone family. By the way, Annika and myself, we called it the Touchstone community, but people in it were like, no, this is a family. And so they started calling it the Touchstone family. Because what does a family do? A family picks you up when you're down. A family will slow you down when you're going too fast. A real family that really cares about you will look after your best interests, not whatever they want. The average person, sadly, in the UK, is like a crab in a bucket. They're down there and they want to pull you back down. If you're watching this, you're doing it for a reason. And the reason is that you don't want that. You want to be different. You want to be part of that 1% that makes a real difference in this world. Because what can you do if you make that difference in this world? Well, you can help those around you. You can give to charities. You can give to housing associations. You can look after people less fortunate than yourself. You're not going to help anyone by giving them your last £10, are you? To give strong, you got to be strong. And if you are that 1% kind of person, then, come along to Well-Through Property, join up with the Touchstone family, and let's go make a big difference in this world together, because it isn't about the money, it's about the choices that money gives you. And we've got to finish up here with point number 9 by saying fantastic job and well done to Her Majesty. Taking us all the way back to 1952. What changes has she seen in her career as a wonderful queen? Huge changes. She's had Winston Churchill as her Prime Minister. I mean, even before she was the Queen, she was driving ambulances during the Blitz, wasn't she? So she's seen so many sights that will be so wonderful, and what a blessed and wonderful life she's lived. This is about property. So what I want to do is what I want to tell you, I've got it written down here, is that the average house price in 1952, when she ascended the throne, was £1,891. £1,891 was the average house price in the average part of the UK. And she's seen this. And if you adjusted that for inflation, if you turn that 1,891 into today's money, if you like, it's round about £62,000. So if the average house was just going to keep pace with inflation, it would now be worth 60 grand or so. But it isn't. It's worth 300,000. So houses have outperformed inflation by a factor of 5 times, round numbers. So whenever you're thinking about, oh, is there going to be a dip or a crash or a slowdown next year, it's irrelevant. If you're a long-term property investor, in my case 40 years, in the Queen's case 70 years, did you know she's one of the biggest commercial landlords in the whole of the UK? She has billions of pounds of property. She is really not a silly lady. She's a very, very clever lady. And she's done wonderful things for the nation, and she's done wonderful things for her family. So whenever you're asking yourself the question, is there going to be a dip this year or not, or whatever, and maybe you're in your 20s and struggling to get on the housing ladder, cast your mind forward, and I'd love to get this in the comments below. What do you think the average house price is going to be 70 years from now? So imagine you're getting on the housing ladder, just like the Queen got onto the throne and became the Queen. In 70 years' time, when you look back, will a blip, will a 5% fall, will it be any different? Because the average house price has gone from less than £2,000 to £300,000. That is 150 times more. So what is 150 times 300,000? Put your answer below. That is the figure that you should be focused on. Because if you're anything like me, I'm past the point, to be honest, where I'm buying houses, or me and Annika are buying houses for us. The investments we're now making is for future generations of our family. It's called legacy. So whether you and me are here in 70 years or not, it's not really the point, is it? Do you want to do something today that will have a completely and utterly massive impact, not on maybe your children, but also on your grandchildren and on your great-grandchildren? How far do you want your name to be carried forward in history? That, my friends, is the question. Not whether there's going to be a housing crash next week. You be wonderful. I'll be Paul. See you next time.